Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, Kevin, welcome again to the Pilot Money Guys. It's glad to have you back 2 weeks in a row. Your fans have demanded it.
Did my mom call you again, Charlie?
Your fan has demanded it.
Yeah, absolutely.
Oh, that's pretty funny. But no, it's good to have you back. And it's good to have you out of the tax cave for a while.
Yeah. Charlie, I'll tell you, a couple days ago, before April 15th, everything was dark and gloomy and the world seemed like a terrible place. And now it still seems like a terrible place, but things are much brighter and the sun is shining. And so we got through tax season, another great year. Our clients are great, Charlie. They really are good at doing checklists. That really is true about pilots. So once again, we appreciate all of the help in getting their tax returns done.
And we people and pilots tend to be really motivated when it comes to either getting a refund or making sure Uncle Sam's not keeping our money longer than absolutely necessary. So the only bad thing about tax season, Kevin, I mean, we love working with our clients and we have some great interactions, but man, that deadline is a killer. You know, it's like a month's worth of work compressed into weeks, which is the downturn.
Well, I'll tell you the ultimate cruel joke that happened this week, Charlie, is that on the 14th, we got a notice from the IRS that people in Tennessee didn't have to file. They have until November. So, I mean, we had already finished everybody. So a few people said, do I really have to pay? And we already, had the money being drafted. So I just thought that was such a cruel joke. But then one of my clients mentioned to me that I don't have to make estimated tax payments till November 5th. And I said, bravo.
Yeah. That sounds a little dangerous though. I mean, just from the practical side, like I'm still going to pay the same amount of tax, just compressed now.
Yeah, well, he's not a sport betting man. If he was, I would tell him he has to go ahead and make the estimated tax payments. But yeah, if you don't keep the money somewhere, you could be in trouble. Okay,
I got you. Yeah, I guess just at least I get to keep it and get some interest off of it, maybe. So
exactly.
But this happened in Florida too. I'm not sure what other states this happened. I was talking to somebody in Florida today. They're like, yeah, we don't have to file. And I know there were the hurricanes and bad weather, and so I guess that's what that's from. I kind of missed that when I came across.
Yeah, they didn't get the kind of reprieve that Tennessee got as far as November, but they did get a reprieve, and it was announced a while ago, which is good.
Gotcha. Okay.
That's the way to do it.
Excellent. All right. Well, good. Tax season is kind of sort of maybe behind us a little until another few weeks, but at least you get to go back home to New Jersey, play some golf with the family and take a break, right?
Yeah, going to the shore. Excited.
Nice. Very cool. Awesome. Well, again, welcome to Pilot Money Guys. We're glad to have all of our pilot tribe with us and the others as well joining us. So we appreciate, and in fact, I'm going to thank everybody in advance for sharing the podcast, for rating and reviewing the podcast. That's really helpful and valuable. So we appreciate that. And I hope you take the time to do that. Go to your wherever you're listening to your podcast and take the time to do that. We really appreciate it. Also, take the time to do the Pilot Wealth Index and see where you fall, see where you stand in as far as, are you prepared, on track for retirement? It's nothing definitive, Kevin. We designed some questions that we thought if people can answer these with confidence, with a good score, then they've got a good financial foundation. And again, it's hard, to make that assumption, not knowing everyone, but nonetheless, those are the best questions we could come up with for that.
Yeah, and we're not in beta anymore, Charlie. But if you take the Pilot Wealth Index and it's not quite what you thought it would be, then give us that feedback as well. We're trying to make the tool better and better.
Absolutely. Awesome. On to From the Flight Deck, a couple questions, couple things, Kevin. Last time we talked about I-bonds. And since then, I-bonds have changed. So starting in May, I believe it is, I-bond rates should be about 4.04%. Now, I say should be because it can actually be calculated. And so I've seen any variations which are basically negligible from 4.04 to 4.07, whatever, about 4%. But that was a little higher than we thought. Inflation's been a little bit higher for longer than most people thought it would be. So that rate has stayed up a little bit. So that might change, could possibly change the way people think about it.
Yeah. So Charlie, we say you can sell your I bonds. Don't sell your I bonds. You can't go back now and not sell them. The issue is that, that's really the dynamism of markets, is that they change. And like we talked about with I bonds before, they change every 6 months. So the 4% might not be 4% in a year. But if I may, I just wanted to share just a little bit of quick education on bonds. If you talk too long about bonds, no one continues to watch.
I'll
But
fall asleep.
for those that are on the YouTube, we have the U.S. Treasuries. This is from Charles Schwab during the day here. And this is what's called the yield curve. It really looks more like this. It really looks more like this, usually, the yield curve. And so you can see that the stuff that's 3 months to a year has really fallen, Charlie. It's gone from 5.5% down into the low fours, high threes. And so anyway, this stuff is available every day. You can see 1 year T-bill now is 4%, 4.01. So the I bonds and the T-bills are right in the same, they're neck and neck right now, Charlie.
Yeah. And oftentimes we look at what's the alternative? Should you take your I bond out? Well, it depends on the alternative. And right now the alternatives all look really similar.
Yes.
I would say that. And do you need the money? Do you need the money to use for something else? And if you do, then get it. If you don't, and if you're lazy, efficient like me, then you just leave it.
Yeah.
Right?
And you don't have to pay taxes as long as it's there. So
there you go. So good. Another thing that we talk about, or have been talking about more lately, Kevin, is when some of our pilots retire, they go from making $450 to $500 or even more sometimes. And then they go to retirement and they're not making that much anymore. The problem is when they go to pay their Medicare premiums, there's a 2-year look back that determines that premium they pay. So it could be a very high premium. So what happens is there is a process through the Medicare, or the Social Security Department is who is in charge of this, I believe, where you turn in an income letter. And by the way, this might vary a little bit. We know what the rules say, but depending on your local Social Security office, they may have different direction. But we've had people have good experience with a letter of income if they have their military pensions going on, any other incomes that they have, that needs to be a letter. And then they need a letter from their airlines saying that they've retired. And that is the event, the reason that they're not going to be making $400,000 or $500,000 anymore. So those are things that are required. One of our pilots, Kevin, they told him to drop it in the drop box at the local Social Security office, which sounds really weird. But
yes.
you can't make an appointment hardly. You can't get in there. You can't do this over the phone. So they said, put it in the Dropbox, these documents, in SSA Form 44. Is that right, Kevin?
You got me.
All right, I'll
I'm
Google
still thinking of 1040s, but go
44,
ahead.
yeah. And you put it in the Dropbox. Again, sounds weird. And it worked. His Medicare premium was lower. And so, again, that's something that's available. Procedures.
Yeah. As of yesterday, it seemed like it was working every time, Charlie, when people had a good reason.
Exactly.
So we don't know going forward, how many people will be employed by Social Security, but it's been a process that's been good. It's worth the trouble. It's worth the money to me to do that, because it can get pretty expensive with the Medicare extra premiums.
Absolutely. And the form is SSA-44. So nice. It also has instructions on there as to what other documentation is needed. But your airline should have the letter that says you are no longer employed there. That is the event that allows you to have a reduced Medicare premium.
I love when you talk form numbers, Charlie.
Yes, absolutely. I got those useless numbers in my brain. So anyway, hopefully that's helpful to people. But Kevin, what we wanted to talk about today, you and I last time got together and talked about the crazy markets, the volatility that we're looking at this year. How do we handle that? But we started thinking too, based on discussions with clients and friends, et cetera, that, hey, what if I'm 64 or, in my 60s, and I have to retire at 65, or maybe I want to retire at 62, 63. And this is the kind of market that I have to retire into.
Or worse.
Or worse. Absolutely.
Or better.
Yeah, absolutely. And when I was brand new FO at Southwest Airlines back in 2007, obviously 2008 was right on, right in my, was that?
He's old.
I know, old. That was a long time ago. But, we had pilots retiring at age 60 then, and into the worst market we've seen since the Great Depression. So that's a tough one. And so we thought that this might be a good time for some lessons learned on retiring into a potential market. So we'll go through some of those today, Kevin.
Yeah. So Charlie, I'll just say this: April 17th. It's been a couple of crazy weeks. As a matter of fact, the month of April has had 47 days so far, and we're only on the 17th. So
that's right.
So this really is a good opportunity to think about it. But as well, like, the market is not down that much. I hate to say that, but I don't believe I have the power to cause things to change. But so you still have an opportunity to think through this and make some decisions now.
Yeah, absolutely. Good wake-up call. I mean, we have seen some unprecedented, and by that I mean maybe 4 or 5 other times we've seen this kind of volatility since 1950. But right now, just to set the stage, again, you said April 17th. The S&P actually, the last I checked earlier today, was in correction territory, just down a little bit over 10%. And that is the definition of correction as far as the S&P, although it's up a little today. So who knows? But the international is doing okay. Some other asset classes are doing all right. So if you are diversified right now, you're probably not down that much. And a 60-40 portfolio is probably down year to date around 5%, probably because there's so many variations there. However, Kevin, the last 12 months, however you want to look at your return, right? People are still in the positive territory. So that's kind of to your point. It's not that bad, relative, historically speaking. So that's where we are right now anyway.
Well, Charlie, you and I, we've seen a lot of market crashes. We've talked a lot about market crashes. And so far, this has been jarring.
Yeah.
But I don't think you or I have started to cry, or I've not gotten in the corner, crawled up with a bottle of bourbon yet. So
that's right.
So it can get worse, is what I'm saying. And again, I think there's always risk in markets. It's just that sometimes when markets actually do crash the way they did, you realize that there is risk in markets.
Absolutely. And again, we like the fact that this is a learning opportunity. We don't know what the future is going to hold. One of our clients / friends the other day said, "Hey, I heard that somebody smart said the market's going to tank 50%." And I said, could happen. It could happen anytime, of course. We don't know. So we do have to be ready for that. And it's a good wake-up call. I talked about some statistics I took some from Ben Carlson's blog post, How to Survive Chaotic Markets, A Wealth of Common Sense. But he said, I think it was, April 6th, 7th, 8th, those couple days that were down. But basically, that's a loss. Those 2 days were a loss of 10% in the market. When I say market, I mean S&P 500. The 10.5% loss was the 5th worst 2-day stretch for the stock market since 1950. The other times were 1987, 2008, 2020, which were some of the most volatile markets we've ever seen. So it was a pretty fascinating couple days. And then we had a huge one single day, 10% not too long ago, or few days ago, but nonetheless, crazy time.
Some of the old guys, Charlie, they used to say 10% down, that's nothing. In 1987, we were down 27.5% in one day.
Yeah.
And people did actually jump out of buildings that day, which, I was a senior in college.
Wow. You are old. Anyway.
Yeah, thank you.
But, all right. So Kevin, we've set the stage. Again, we don't know where the markets are going to go from here. And I think you nailed it in our last podcast. It's not an anomaly for markets to go down. It's a normal part. It's not a malfunction. It's a normal part of the markets. But if you were an airline pilot and you were 64 at this very moment, and you hadn't thought one iota about your retirement, your investments, Tell me what's the first thing you would turn to and think about and try to go, hey, I got to get a handle on this. I'm on the doorstep of retirement.
Yeah, so that's a great question, Charlie. And to me, it's all about risk. Okay, so the risk is not just about getting good returns anymore when you're going to retire. The risk is about eating cat food. And so what is your asset allocation? And I'm sorry to be so dramatic and try to scare people, but you know, you can really get lulled to sleep when markets are doing well. You can forget that they can massively go down. And so the first thing I want to do, Charlie, is I want to look at all my assets. What are they worth? And what assets really, if we have a really bad stock market, real estate market, what's my potential risk? And if you can't figure that out, talk to somebody that can help you with it. That sounds like I'm saying that you should call us, but anyway, you just need to try to get a handle on what your risk is.
Yeah, absolutely. It's pretty serious. I mean, it is. It's one of those things where I think you and I both agreed that if we were 64 on the cusp of retirement and we were faced with this wake up call, that's probably the first thing I would do, because I've got time to plan for budgeting, for spending, for other things that need to be done, long-term care, Social Security, all those other things that have to be done to prepare for retirement. I've got some time. But man, at this point in time, if I'm on the cusp of retirement and the market takes me out, that could be a long, difficult recovery. And it could require me to adjust my retirement lifestyle, which I really don't want to do. We don't want our clients to have to do that. So I tend to agree with you. That's I think urgent might be the right word.
And just to pull back a little on what I just said, to make sure I'm talking out of both sides of my mouth, Charlie, is that probably even if markets do crash 50%, they will come back. But the issue here is one of not just financial well-being; it's also emotional well-being.
Yeah, and sequence of return risk is a fancy phrase that's thrown around in the nerd business all the time. But it means is, it's a mathematical thing where you're starting to pull money out of your portfolio, and because of the time value of money, I knew the math at once. Present value, time value, whatever. It's a bad time for your investments to go down, because you're going to start removing money from your portfolio because you need to live on it. Most people need to do that when they enter retirement.
Yeah. Charlie, if I can just pile on there. So most people know compound interest, one of the miracles. Well, sequence of return risk is the opposite. You're pulling larger sums of money out as your portfolio goes down. And therefore, you need many, many, many years of positive returns to make up for those first few years of downturn when you're pulling money out. And many times it can't be done.
Absolutely. Yeah, it's kind of a big deal. We'll cover that whole topic on a whole nother podcast. But we also wrote down 7 things we can do today. We might throw in a bonus 8th or 9th, depending on our time constraints. But anyway, so we wanted to pass on to those of you that are getting near retirement, things that you can do other than what we've already just said, maybe including what we've already said, that you can make a lot of progress towards being prepared regardless of the market. So the first one I put down here, Kevin, is what you alluded to, right? Number 1, take inventory. What are your assets? What are your liabilities? Also known as net worth. What are going to be your income sources in retirement? That's kind of, I don't want to say easy. Sometimes that's not easy getting organized that way, but get that stuff written down, documented. I think though, Kevin, the hard part is when I say take inventory, what the heck am I going to do when I'm 65 and I leave my airline or my fractional corporate job? What am I going to do? How much is it going to cost? That's really what I think is a little bit harder.
Yeah, and I'll tell you this, Charlie, I've not met a lot of people that know exactly what it's going to cost. Even some of the budgeters that we work with, they retire and they're like, wow, this is different than what I expected. And that's just you have to adjust to the new lifestyle. And for the first couple of years, a lot of people spend a lot of extra money because, you're feeling good. You've never gotten to take a month and go on a worldwide cruise or something like that. So people might spend more money, but at least thinking through it is a great exercise.
Absolutely. A lot of times we don't even budget very well, Kevin. So we have a hard time, preaching that to our clients, and we don't. A lot of them don't need to do that. But at some point before you retire, it's time to track at least what you're spending. Not a true budget where you're constrained or whatever, but at least know what you're typically spending things on and how that might change in retirement. And then I think a good technique, Kevin, try it out. You're 64, give it 3 or 4 months of your quote unquote retirement income budget. Try it out, see if it works. And so we've seen people do that with success. I think that can help bring some peace of mind too.
So, Charlie, one of the things you learn when you're a new financial planner is the power of the bar chart and looking at how much you're going to spend each year on different things. And so we're not saying pilots need to make bar charts or anything fancy, but just knowing that, like, hey, this is what my medical's going to cost. This is about how much I need to live. Maybe you say $10,000 a month I'll need, or $8,000 a month, or whatever that is. And then if you have other extraordinary expenses, so just try to figure out about what that's going to cost you. I think that's a lot better than trying to budget, because budgeting is no fun.
Yeah, that's the truth. It takes all the fun out of it. Number 2 might be the corollary to what we just talked about, but I believe that you got to do the math at some point. You got to figure out, and there's a lot of different ways to do this. We'll talk about a couple in a minute. You got to figure out, how long your money's going to last, and how much can you take out of your portfolio without putting yourself at risk. And we're mainly talking to people, Kevin, that are do-it-yourselfers. Obviously, we have software that does this.
Right.
Go through lots of different scenarios. It's, I think, one of the most complex things we do, and it's very dynamic. It changes a lot. But nonetheless, if you're a do-it-yourselfer, you got to put some thought and effort into the math. What is possible and how much I can spend. What do you think? How do you do that, Kevin? Any thoughts on that?
Well, I mean, I think, tools that Fidelity has, Schwab has, they're interesting. There are more sophisticated tools. We've had some do-it-yourself pilots reach out to us over the years, and they showed us their plan. And, sometimes I've been very impressed with some of the different softwares that are out there. So it's possible to do it using different software. Mm-hmm. But again, I think, the 4% rule gives you, maybe not a rule, but it gives you some estimation of what how long your money might last. And there's lots of other tools there, Charlie. But you tell me, what do you think? You asked the question. Maybe you know a better answer.
I don't. but I did put on there. I didn't explore this. I was like, I wonder what Chat GPT can do here. You know what I mean? But anyway, I have no idea. Kind of. I would assume it might be able to point you in some online calculators. I did try one, Kevin. I went to calculator.net and I just put in, hey, I'm 64. I'm 62. I make X amount and I want to spend a certain percentage. And it showed me some graphs. It showed me some numbers. It would be difficult for me by myself to take those numbers and then just go with it. You know what I mean? I think that would be difficult because I need to know what that means. And it shows me running out of money at 89, but maybe that's because I told it I was going to live till 90 but I don't know that. What if I lived to 95, Kevin? So I'm not sure how I would do that if it was just.
Well, our clients are highly educated.
Yeah.
Some of the engineers we work with, Charlie, they have 72 spreadsheets. They're better at Excel than you and I are.
Yes,
but just trying to figure out some construct that works in your mind of how you can plan, I think is really the key.
Yeah.
And there's lots of material out there. There's lots of good books as well. But just trying to get a construct of how you're thinking about it, and then ask some other people that might be do-it-yourselfers too.
Yeah. And this is, again, not an easy field of study. There's books written on this. You've got the RICP designation, retirement income something plan.
I don't remember.
I can't remember. But anyway, you spend a lot of time on this. It's takes some thought, especially if you're doing it yourself. Number 3 is kind of maybe should have been first if we were doing order of priority, because I put make sure your portfolio is prepared. And that's asset allocation, that's risk, that's diversification, all those cliches sometimes that we talk about a lot. That's really important here to think about. Are you ready? Are you 100% stock and you're 63 years old? That could be an issue, right?
Unless you have maybe 500,000 in the bank, then maybe it's not. But yeah, you're exactly right. And so, I mean, this stuff is tired and true. And I say tired just because it's the same advice that people always get when they're nearing retirement, is just to understand, how aggressive are they? And again, I'll foot stomp this one, Charlie, is that it's first about risk, because it's really great to be able to eat caviar and drink champagne if that's your thing. But, there's also the downside of that. You only get one chance at retirement. And for those that do it really badly, you could end up being in some trouble. And so risk comes first in my mind, Charlie.
Yeah. And that is a, portfolio risk and diversification. All those things are really nerdy, academic, but I think, and they're important, don't get me wrong, but I really think what's happened here sometimes, what you and I see, is there's a behavioral component. And that behavioral component is that we get a little complacent sometimes because the S&P or the Mag 7 or stocks have done so well for so long. We get lulled into this. We get lulled into this mindset that, hey, I'm going to be okay with a little more risk, and let's take a little more risk. The stock market's been doing great. I don't want to miss out on anything. And then when these kind of hiccups or corrections occur in the markets, it's really I think a healthy wake up call. But there is an academic idea that I think is at play here, and that's called the recency bias. We are our minds are programmed to help us remember and essentially overweight information, give it too much credit, if you will, that's happened in the recent past, because it's meant to save our lives. Like, Kevin, if you and I are going through a four-way intersection and the light turns red or somebody's running the red light, I don't need to analyze the statistical history of my survivability at that point. I need to put on the brakes. So that human bias is at work here, and it really lulls us into a complacency where, hey, things have been great. I could be 80, 90% stock. Things will be okay. And unfortunately, sometimes they're not okay. So yeah.
So Charlie, let me jump on this one. This is really fascinating to me. Is what's happened over the last couple of years, and this has happened to you and I as well. Is it just seems like stocks are safe and they go up, and if you just invest in the same old companies, they always go up. And so many of the people that we've seen recently, they have a lot of these Mag 7 stocks. They own a lot of growth stocks, and the S&P you said was down 10%. Some of these growth indexes are down 20 or more percent. So I think for our clients, as well as our friends in the cockpit, a lot of people, they blew it. They overdid it with these things. And so it's still not too late, though, to learn from it and or just reset yourself right now going forward. I mean, the best time to get out of all of those really high price things was probably last year, but you can't go back. So today, how much growth do you have? You could have 10 different mutual funds, and all of them could own the Mag 7 in really high percentages. So again, that's where getting an accounting is really important. And then just seeing what your potential risk might be. 2022, Charlie, how long ago was that? Not very long ago.
3 years ago.
But I remember those same stocks crashed that year, and then the year after they went up 100%.
Yeah.
So we're not saying that it's down and out for the ones that have fallen again this year. We're just saying this is a time to relook at it again and reset your sights on what's important to you as a person that's going to retire.
Absolutely. You nailed it. And it takes a lot of discipline to do that. It's not easy. Step number 4, Kevin, this is your bailiwick. And that's a word that old people use. So I'll throw it out there.
Never heard of it.
Start using that more. But thinking about tax efficiency. This is going to be level, a little higher level thinking, not an urgency kind of thing if you're 64, but it's something that can really be a tremendous tax savings throughout your lifetime of tax liability. There's lots of things to do here for near retirees and even retirees well into retirement. What's the top of your mind on that?
So first of all, I think just talking about the 64-year-old here is not fair to our other aged people. I'm staring down the barrel of 60 soon. I won't say when, but sometime in the future. And, when I talk to 58-year-olds, they're thinking about the same thing as the 64-year-old, that, the time is limited. Yeah. And I think of that too now, Charlie. So, but as far as tax goes, it's always a good time if you can get a freebie with tax. And what I mean by that is when markets go down, maybe you have a big IRA, you might consider doing some Roth conversions. Again, if you're earning a retro bonus like last year, maybe not that year, but in other years, you might consider doing a retro bonus. If you're somebody who's charitably inclined, you could give a lot of money in a year, use a donor advised fund or other ways, and do a Roth conversion. Doing that, you can sell losses in your taxable account. They're of great benefit. We've seen some people retire, Charlie, and they have like $150,000 worth of losses. And they've come to us and they say, I'm kind of embarrassed. Look at all my losses. And we're like, this is a great thing. This is an asset now going forward. It's called a tax asset. Boy, how nerdy is that? But when you're in retirement and you go and you sell all your winners in retirement to buy a new car, you have all those losses to offset them. You don't have any tax bill. So you kind of prepaid your tax in the future with your losers.
Yes. Yeah, that is super nerdy, but it's very valuable. And those are things that we look at. Those are things, even in down markets. Like I think you stressed it. Like that's a great opportunity to look at some of these tax loss harvesting, Roth conversions, and well into retirement, we're looking for opportunities to convert to Roth. And essentially what we're looking for are those opportunities to prepay tax at lower rates, if possible. Not always possible, but we look for those opportunities, and that can be tremendous tax savings. But as you said, we don't want to be age discriminatory. So we're going to talk about if you're a little younger, 60-ish, you've got salary deferral options at some airlines. Non-qualified. Yeah, can save you tremendous. The market-based cash balance plan, Kevin, we're going to talk to that, in another episode at some point, but that's a great opportunity. United's got a couple opportunities as well through the RHA and the HRA. So those are opportunities as you get, I think, late 50s, early 60s that start to become really, really valuable and can save a lot of taxes.
Charlie, you just got me so excited. I mean, that's the great part about knowing when you must retire, is that you really can do some tax planning, like just have more money going to the non-qualified as long as you don't think the airline's going bankrupt. We have to distance ourselves from that one because that's happened in the past. But there's different things you can do in the last number of years. You can give more away in the last number of years. And then when your salary goes down, you have that money in like a foundation, a donor advised fund. There's so many exciting things to do in the last few years of working years. Yeah,
absolutely. A lot of good levers. One of the things, again, for those that are not within a few months or a year of retirement, but start building that bucket one we call, where you've got either cash in the bank or in a brokerage account, again, depending on your other savings. But boy, it's nice to have a healthy amount of cash or cash-like investments going into retirement because it sets you up for those opportunities to be able to ignore the bad stock market if it were to come the year you retired, and B, presents more conversion opportunities because you have monies that you might be using that are not taxed. So I think that's a good foundational thing to set up late 50s, early 60s, or earlier if possible. So
yeah. Well, the taxable brokerage account, the most unknown, underappreciated retirement account there is, absolutely is fantastic when you want to do Roth conversions, or if you don't want to take money out of your retirement accounts.
I like the fact that you were enthusiastic there. I could see the energy coming back after taxes.
Yes.
A couple others, because we're running short on time. Lots of stuff to do here. We can send a checklist. Just reach out to us, charlie@leadingedgeplanning.com or kevin@leadingedgeplanning.com. We'll send you a good checklist. But you need to think about Social Security, Kevin, Medicare, how that's going to work for healthcare cost. But I'm going to throw one out, and then you throw one out as we wrap up.
Yeah.
One of the ones I think is the most important, kind of non-financial, turn off the news. We had someone the other day call us from a cruise that they were supposed to be enjoying, but the news was too bad. And I was like, please read the news,
Turn off the news.
find other sources. But the news, I don't care whether it's CNN, Fox, whatever, they are designed to put out news that gets your attention, hooks you. Your amygdala brain, lizard brain, is ready for the bad news, and it's going to pounce on it and make you angry and miserable. So turn it off and enjoy retirement.
I would hate to retire and just watch news all day. And that's the number one thing that people do.
Mm-hmm.
And so, turning off the news is a tremendous blessing. If you don't pay attention to it, because you can't do anything about it anyway, that's not a terrible thing, Charlie.
I know it.
So I guess my idea for people is that, the teacher will come when the student is ready. And in this case, a lot of times we don't think about all this stuff about retirement because it's foreign to us, like how to think about Medicare. Who understands Medicare? A few dorks that sell Medicare insurance, it's like, who understands Social Security? Well, we do. Mm-hmm. But, learning all these different things, the concepts are not that hard, Charlie. You just have to kind of wade into it a little bit. Understanding asset allocation and portfolios. Again, it's not that difficult. It's just that you have to start learning. So it's a good day today to start learning about what retirement might be like.
Yeah, absolutely. And Kevin, we do this podcast to try to help people, but and we are there are people that can do it themselves. There's no doubt. But yes, we obviously do this. We see it all the time. We have a process for it that we believe is effective and can help. So just give us a call, and we're happy to have a consultation. If we can help in 30 minutes, we will. If there's more needed, we can just do the best we can and try to help any way we can. So
yeah, Charlie, we talk to a lot of pilots that don't need us. Mm-hmm. And we still talk to them. We give an hour, and that's kind of been our mission since the beginning is try to help where we can.
Absolutely. I love it. All right. So hopefully today was helpful. We hit some good hard-hitting foot stompers. And so, again, just follow up if you have any other questions. Me or Kevin are happy to answer those or get on a call if that could be helpful. So thanks again for listening to us. Please share the podcast with anybody that you think might benefit from it. Give us a rating and review, and we'll see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.